welcome everyone to our webinar, and welcome to VCapital. We're thrilled to be able to have a conversation with you today, and we really appreciate you making time for a little meeting. We typically will do 2 to 3, sometimes 4 in-person meetings with our clients and friends of the firm throughout a year, and because of the COVID restrictions, we've been unable to do that this year and relegated to Zoom meetings. But we found that they really make a lot of sense, and we're able to reach a broader group of people in a more effective fashion. So really appreciate you taking the time to listen to our conversation today. The purpose of the meeting today is to familiarize you with venture capital as an asset class and how we navigate venture capital to present some compelling investment opportunities. Most of you on this call are either vaguely familiar with what we do, or this is the first time for a little more in-depth conversation. And we've connected either through LinkedIn or some of our outreach. And so we hope that you'll find what we present today effective and helpful. So our agenda will be about 20 to 30 minutes of listening to Rich and I drone on and on. I'm Jim Vaughn, by the way. Forgot to introduce myself, and this is Rich McMenamin, my colleague. But the agenda today will be about 20 or 30 minutes of talking through a slide presentation, why we feel venture capital ought to be something that's considered for your portfolio, and how to go about it in a very prudent manner.
Okay, I love this opening slide that captures a big, huge wave because even though I'm not a surfer, my sense is that catching a great wave and being in water with that much energy is probably pretty exhilarating and thrilling when you do it right. But if you don't do it right, you're going to have a pretty big wipeout and maybe a lot of pain and who knows, potentially even something worse. So I think that it's a good analogy in the sense of venture capital. A lot of our investors that we've worked with or talked to from time to time, they're interested in the thrill of investing in cool companies and making money, but they don't always have a path of how to do it, and that's what we're going to address a little bit is our approach. So we're going to talk a little bit about the surfboard today to help investors that want to consider venture capital. Ultimately, we think have a guide, and that's what our approach is it's kind of a guide path forward to how to make venture capital more pain-free and hopefully a little bit more thrilling. So one of the questions that we run into all the time is, why are investors looking for venture as an alternative class? I know when I started investing early on, Jim, I was really focused on number one, just I wanted a big return,
right.
And I wanted to have the excitement factor of.
And that's typically why people look at alternatives in general.
Yeah.
Normal market stocks and bonds have become so correlated, Rich, and over time, and alternatives have become more attractive if people seek out higher returns and more diversification. So.
Yeah. So in my own investing path, I've learned that diversification, of course, is a really important component, and so a lot of our investors are moving in that direction of diversifying their overall portfolio. And of course, over the last 20 years or so, on the fixed income side of your portfolio, many investors are just getting clobbered. There's not much return there. And so that's another big driver.
And we wouldn't say that venture capital is a substitute for fixed income, not in any way. But when you look at overall asset allocation and fixed income being such a challenge, people are seeking out other alternatives and then looking at the other end of the spectrum with a little bit more risk to balance things out. It's just changing the whole game. So.
Yeah. And then there's a fourth driver that I think is really kind of interesting and is a growing dynamic, I'd say, with some of the investors we're talking to, and that's the intergenerational wealth planning component and how venture capital can be really an important element in a strategy. And so we'll get into that a little bit more. Now, the challenge, of course, with our investors is, I'm interested in venture capital, but I have no idea where to look for these deals. I'm not sure I can even gain access to them. How do I do that? What criteria should I be thinking about in terms of why is one deal that my down the street neighbor presented to me either a good one or a bad one?
Right. there's no real central way to access things, and there's not a raft of mutual funds or a listed exchange with venture opportunities, and it's really challenging. And more often than not, people lose money because it's my brother-in-law knows a guy and they're putting together a deal, and it's a restaurant you want in, and there's just no way to, accurately gauge whether or not it makes sense. So
yeah, agreed. So we're going to address some of these questions here, which is a big part of our overall value proposition: the where, the how, the what, and the who. So let's move on. I think you're going to talk about some of the indexes, Jim.
Sure. I just like to compare venture capital against indexes over periods of time, just to give you a feel for how the returns might be attractive. I always tell investors they have to have a long-term outlook in order to really go about venture in a prudent way, thinking in terms of 10-year money or more. One of the downsides is your money is tied up. It's not liquid in most elements or most vehicles. So getting your money out, if one or more companies should experience an exit transaction and sell the company, you might have a return before that, but you really ought to go into it with a thought that my money's going to be tied up for 10 years. So looking at that, I would ignore the 1-year benchmark comparison. But if you compare the blue venture capital index, and this is an index of all venture funds across the country, to the S&P 500 or the Dow Jones, I think the S&P is probably the best benchmark, which is the gray box picture of the overall broader market. You can see that in any given time frame, venture works out pretty well if you can go about it the right way, and that's really what we get into in the next couple of slides. When you break venture down into, it's made up of different stages. So some companies focus on early stage companies that are just getting off the ground. You have to wait longer to experience an exit, but oftentimes it's much more rewarding. And if you break down early as opposed to late stage or multi-stage, investing in all stages, the early stage certainly has some advantages. In particular, as you can see on the right, when you include some unusual times in the market, it can be rather earth-shattering returns from time to time. The other thing that is difficult, and this paints a picture of how you can get in or where you should get in and whether or not to consider venture. One of the reasons it's difficult is because it's difficult to access the right funds. If you look at venture as an asset class, the returns, the annual returns between the top quartile investment funds, venture investment funds, and the bottom quartile investment funds is extremely wide. It's extraordinarily wide. If you look at this chart, which we've kind of got it backwards here, but in any given year, and these are just snapshots of the given year, you can see the spread between the top performers and the bottom performers is enormously wide. In another asset class like large cap stocks or even small cap stocks, that return gap is much, much narrower. So what that illustrates is, I always tell people if they can't get into top performing vehicles, you might as well stay out of venture capital because you're not getting paid for the risk. And it's very difficult to access top quartile funds. In most cases, you have to know the right person, and you have to have at least $500,000 minimum investment to get in. And in some cases, a Sequoia, a Kleiner Perkins, one of the really, real top famous ones, takes at least $1 million to get in. And most people are thinking in terms of asset allocation, a 5%, maybe even 10% allocation to alternatives, and venture is a slice of that. You have to have a boatload of money in order to invest $1 million. So we try and create vehicles for people that have done well, but may not be what we would consider ultra high net worth, to get involved in a really compelling fashion.
Yeah. So Jim, I think your slides that look at venture as an asset class are really insightful, because the data makes the case as to why it can be an attractive alternative area to invest in. The next few slides, we're going to shift a little bit to talking about our model, because it's slightly different than other options out there. And we're really trying to capture some of the key components that make up what we think is our value proposition. And maybe one of the most important ones is number one on this slide. sourcing and vetting really high quality deals. As you mentioned, the top quartile funds, the minimum investment is going to be, $500,000, $1 million or so. We're trying to bring really good quality deals to our investors with a lot lower threshold, and we'll talk about what the minimum investment is in a minute. But essentially, we have a network, and we're gonna show just a sense of where we originate our deals from, and then I'll go back to the other slide. But we're receiving about 1,200 decks a year from potential companies that are looking for funding. And they come from a wide variety of sources, from accelerators and incubators and university tech transfer offices, to our own investor base that have opportunities presented to them and they share with us, to the government, to other VC firms that we either have met over the years or part of our own Midwest Venture Capital Consortium that we've put together.
It's one of the advantages of being on the back nine of a career and having been doing this for a long time. You build a lot of relationships over time, and you are able to source deals from a number of different directions. It really pays off.
So we're just inundated literally with decks, and we stick pretty close to our knitting in terms of investing in life science based companies that have a healthcare component, or more complex information technology, largely software. So those two sectors are where we're looking at, and we are looking at them on an early stage basis. And again, the strategy is partly driven by the returns that Jim walked us through, where generally we think that there are higher returns to be achieved by investing in early stage companies. So most of our companies that we're looking at are pre-revenue, they're development stage, and they're building out their platform.
Usually when I'm presenting to someone, I get a hard stop here and someone says, how in the world, you guys are a small team, how in the world can you vet 1,500 deals in a year? And how can you really be generalists and not focus on a particular industry?
We're fast readers?
A firm our size, typically, a lot of our competitors will focus on a very narrow band of the market and focus on healthcare deals, or even a specialty like cardiac within a healthcare deals or something like that. Whereas we're looking at a broad market, we will look at just about anything. But lots of times we can dial in and lean on our network of experts that we know, subject matter experts, to help us vet these companies and ask the right questions and really get to the bottom of the story to determine whether or not it makes sense for us to do deeper homework.
Yep.
And out of this 12 to 1,500 deals, we're able to winnow it down to a very manageable group in pretty swift fashion.
Yep. I was being a little flippant with the fast reader comment. We don't look intensely into that many deals. If we get 1,400 deals a year, there's no way we could do justice to that. As Jim said, we winnow them down because we're looking for specific kinds of companies and criteria that have them. One of the criteria, curiously enough, again, this is data driven, and we'll share some of the supporting data on it, is the geographical preference that we have for the Midwest. Mm-hmm. And that's because the returns are slightly better there. Not slightly, actually a pretty significant delta on returns. So I'm going to.
We can come back to that.
Yeah, we'll come back to that other one here in a sec. But let's talk about the Midwest and why we like the Midwest so much, Jim.
Yeah, I mean, we've looked into this, and this is something that is dynamic and changing pretty rapidly. We had an interesting conversation with the founder of one of our companies just recently, when we were asking him how COVID has changed things for him. And he was saying, of course, we're working at home like everyone else, and that's changed, and he doesn't think it's going to go back. He just hired an engineer, this is a software company. They just hired an engineer in Australia that they've yet to meet. And he said, the days of going back to work, it'll happen, but the days of having everyone go back to work, everyone being in Chicago, those days are over. So it's really opening up a lot of markets. And what we're finding is the cost to the entrepreneur to build a business in the Midwest is far, far less expensive than it is in the traditional hotbeds, San Francisco or New York, one coast or the other, sometimes Boston, for the companies to grow this business.
Right. And as a result, because the costs are significantly lower, not just for rental expenses like what we showed, but whether you're hiring an attorney or an accountant or hiring staff, salaries are lower in the Midwest. There's a lot of factors that contribute into that. And so what is the net result of this? When you're buying into a company from the Midwest, generally these lower operating costs drive a valuation that's significantly below in the Midwest compared to the coast.
And valuations are the price that we pay for the shares that we purchase when we make that investment. So the lower that valuation is, the more we can negotiate our position and the better off our multiples are going to be on a long-term basis.
Right, and it's almost like interest rates and returns that are inversely related. The lower we can buy in at that valuation, and the market determines the exit price, that the bigger the multiple is going to be, and we show that here.
It also begs the question as to why we participate in early stage versus later stage. Later stage companies have a higher chance of success and usually a shorter time frame to exit. But the chances of getting into a really high quality deal at a later stage, a series B, C, or D, right before they go public or sell to another company, are very, very slim. Yep. So we feel that a lot of our competitors have large institutional funds and they don't really want to wait that long to get paid. And there's this opening, this white space in the early stage that if you go about it right and you're really good at doing homework and you can negotiate terms properly, your chances of success go up.
Yep.
That's why we focus on that end of the market.
I wanted to come back to this slide, Jim, because we talked at the very beginning and the broad range of areas that we think we're bringing value. The sourcing and the vetting is just so important. And this is one of our CEOs that we work with. The company is Radiant Oximetry, and a relatively new investment that we made in the spring of 2019. And Neil has spoken about the value that we bring, which is great to hear. But here's the key for me is I think our due diligence is just something that our companies pick up on as well, the ones that we invest in. No problem. So I think we worked on Radiant almost 9 months. So that's really 9 months of looking at the market space, understanding the dynamics, some of the technological hurdles that the company is going to have to get over, the competition, who else is in this space, and why is this company more likely to have a successful exit? Right. Who might some of the likely acquisition candidates be 3, 4, 5, 6, 7 years down the road?
Who are the threats to jump in front of them and get to market first?
How strong is the intellectual property underlying the technology? Right. These are all kinds of things that we rely on our own internal team and a vast network of professionals all over the country, literally, to help us dig down into making the best possible choices that we can.
I would say the other thing, that's a really good point, Rich. I think the other thing that is important is to know that we look at it, and you're going to see a quote from one of our investors as well, and we really think of it as a three-legged stool. There's us, there's our entrepreneurs, and there's our investors. And our entrepreneurs have to know that this is a partnership, and we are not just writing a check and going away for 10 years and you tell us if we won at the end. We are active investors. I wouldn't say we're involved in managing the day-to-day aspects of the business, but we are in a connection with them on at least a monthly basis. I would say Neil Ray, who is one of our best CEOs and founders, I would say we talk to him quite a bit more often than that. And Bert Toss is another one from our most recent investment, Centiar. We just made 2 strategic introductions for them, and it looks like it could be a real home run. So it's good. We also will help them raise capital. So when we're investing, we try and recruit other VCs and other high net worth investors to come in and be part of the program, and they can add value as well. So,
Jim, we're having so much fun talking about these companies. I forgot where we were, but now we want to talk a little bit about just again, the kind of the strategy that has this concierge aspect to it that we reference about diversifying differently.
Yeah, and we feel here this is where we really are different in how we're structured and how we offer our investment opportunities to high net worth investors. We don't operate with a fund, which typically most venture companies do. We roll out our opportunities on a deal by deal basis. So in each case, when we find a company like Radiant Oximetry, we will form a special purpose vehicle, and then we will pool money into that vehicle, and that vehicle invest as one unit in each of these companies. So our investors have the chance to pick and choose investments that they like or dislike. They can add more money to some and not on others, or they can choose to pass altogether. It's a little bit more work for us that way, but we feel it has great advantage both to us and, more importantly, our investors. We try and paint a good picture. We'll lay it all out for them, but each time we raise money for a company, our investors are stepping up and deciding to invest or not. Because some of our investors also are looking for more of a diversified approach. If you could back that up just one.
Yep, sorry, Joe.
That's right. We offer the ability to partner with VCapital and invest at the founders level. So you can invest directly in VCapital, which is kind of part of our profits in any one of these deals. If you start with the individual deals, our charge for investing in the individual deals is 2% annually plus 20% of the profits. So if a company actually gets to the finish line and sells to another entity and there's a profit there, the investor gets 80% of the profits, we get 20. When you invest in VCapital, you're buying a share of that 20% carried interest in all of our companies. That goes for the existing 10 companies that we have now in the portfolio, soon to be 11, and any deal we do going forward for the life of the firm. So where it is a lower chance of huge returns that you might experience with one deal that happens to hit a home run, you don't have the risk of being involved just in one company. You're spread out over 11 companies and hopefully more in the next few years as we add companies to the portfolio. So anybody who wants to know more about that, we can certainly talk about it or answer questions that you might have. But it is kind of a unique structure, and we think it has some advantages.
We spent a lot of time talking to prospective investors about this risk-reward relationship, and we're happy to delve into it because, again, a lot of the people we're talking to, this is new space, and so we take great pleasure in walking people through the process and the options of how to invest with us. So, Jim, Concierge Services has been a hallmark of you and your style for a long time.
Yeah, this is one of our most interesting and trusted investors. He represents a family group that invests with us, and we asked them for a quote, and they said, far and away, it's the trust. We like to be very transparent. We hold 3 or 4 investor meetings a year with updates on all of our companies. Plus, we send out information when something good or bad happens to them along the way. And, we're very honest with what's going on, right or wrong. And, Chris and his family really appreciate that and count on us to give them the straight story of what's happening. So.
Oh, boy, I love getting to this slide because this is kind of that coolness factor that I love to talk about, which is the portfolio of companies and technologies that are represented. And there's way too many for us to get into. So I think you said the other day, portfolio companies are kind of like kids.
Yeah. Who's your favorite child? I never answered that question, but no, it's we could talk for days about all of these companies, and we certainly won't bore you with that now, but I'll just give you a kind of an update on one of our companies that has been in the portfolio since the beginning. This is our first investment in late 2015, early 16, called Intensity Therapeutics, and it is a drug company, pharmaceutical. It is a cancer-fighting agent, and typically with biotechs, we run the other way when we see one, and we certainly did with this one. It was introduced to us by a friend here in Chicago. The company is domiciled back east, but he knew the founder very well and convinced us to take a look. And the more we took a look, the better it looked. And we realized that it wasn't just a new drug. This is more of a delivery system for drugs, in this case, chemotherapy for cancer. But this founder was basically telling the medical establishment, you guys have been fighting cancer all wrong for 100 years, and I've got a better way. And I'll tell you what, that takes some intestinal fortitude to stand up and do that, and even more so to invest in it. But we really felt it had a clear path to a big, big sale, and thankfully they are on the right path. We have been through preclinical trials with mice. They got FDA clearance to go forward with phase 1 human trials. They've been through that now, and now we're in the middle of phase 2 trials with human beings. They've treated 15 different tumor types. So these are tough cancers to beat, and they're getting just outrageous data back. They're saving lives. So we're very high on the prospects for this company. It looks like there's been some activity in the marketplace recently with a couple of enormous sales to pharmaceutical companies with other similar size companies and stages. And we're looking forward to great things with Intensity Therapeutics. Another outstanding founder in Lou Bender. He's very much like Neil Ray, and just very cooperative, and we get a great line of communication with him.
Yeah. So, I'm going to talk for a minute about one of my favorites, which is radiant oximetry. I referenced the founder, Neil Ray. Curiously enough, Neil, who was a doctor and went to Harvard Medical School, is from the Midwest. He grew up in a west suburban setting in the Chicago area, and now the company is in California, but has this Midwest flavor to it through Neil's unbelievable leadership
and work ethic.
And work ethic. But so what's a few things that really make Radiant so compelling, I think. First of all, talk about a market. There are 140 million births a year globally. In the U.S. alone, there are 4 million births.
That's a lot of diapers.
That's a lot of diapers and a lot of deliveries, obviously. And radiant oximetry is using a new and more accurate technology, we believe, to assist the delivery team, the doctor and nurses, at the time of delivery. And so basically, this is an upgrade to traditional fetal heart monitoring systems, which have been used probably, I'm thinking, for over 60 years, long time, and isn't really much better than a coin toss for accuracy. And so in the U.S., over the last 40 years, there's been a fourfold increase in the number of C-sections without much improvement in reducing or preventing baby birth injuries.
We actually have the highest percentage in the world of C-section births.
Yeah, so this technology, which is a optical strip placed on the mother's abdomen, it's non-invasive, will be able to distinguish between the mother's blood and the baby's blood.
Oxygen level in the blood.
Correct, oxygen level, which is a much more accurate indicator of stress for the baby and or the mother. So this just has potential huge applications, not only in our country, but around the world. There's tons of really great developments taking place with a cool company led by a fantastic doctor and team of professionals that are just driving this one forward. We're really excited about it.
They are also in the operating room and partnering with other devices that are in the operating room made by companies that will be their acquirer at some point. So there's great notoriety of what they're doing and exposure for them as they do that. So,
Jim, I have to do this. We help launch these companies. Why don't you talk about Atlas Space
so
Operations?
This is Rich's favorite company, and it's called Atlas Space. This is a group of guys who, it's 6 guys to start, who founded this company. They are ex-U.S. Air Force aerospace engineers. Most of them worked for Northrop Grumman after retiring from the Air Force. And they realized that the commercial satellite business and the government satellite business was just going through exponential growth. And that was due to the fact that, a satellite used to be as big as your house and would cost $500 million to get up in the air. And now the technology has grown so dramatically that, they're the size of a toaster oven. They'll send them up 40 or 50 at a time, and they only cost about $5 million as opposed to 500 million. And so it's changed things dramatically. They are doing things like weather, fighting fires, chasing cattle in Australia. All kinds of things are reporting back to Earth with satellites. The problem is the rockets are sexy. That's really great. The satellites are sexy because they're getting smaller and cheaper. The ground systems, which is the software and hardware that collects the data from the satellites, unpacks it, and makes it available for the end client, was invented in 1952 by the US government. And it hasn't changed since.
Yeah.
These guys sensed a real opening and an opportunity for improvement, and they have created a software and hardware platform that does that. And right now they're the only US-based company that's doing this in the way that they're doing it. And I think they've got a giant head start on things. So they have a great foothold in both the commercial and the government markets. And we're just going along great guns with them. So.
Yeah, and I want to jump in and say even more, but in the interest of time, we're going to move on.
You don't want those two ugly ones.
Okay.
I will say a little bit about our founder, Len Batterson. Len and I partnered first off 11 years ago. At the end of 2008, as the world was melting down, I had spent 11 years at William Blair and Company, and it was the perfect opportunity as markets were changing to step away and do something different. And fortunately, I was introduced to Len. Len's been involved in the venture capital business since the early 80s. He'll forget more about venture than I'll ever know. He's a very astute investor, has a long established track record in history, is a wonderful human being on top of it. And fortunately, we're able to tap into his wisdom and guidance on the investment side. And it's really helped us to some big wins along the way. So we're looking to continue to grow the firm. We're adding talent like Rich and Ryan Cole and others. And, we look forward to great things ahead. We're very bullish on the current venture environment, even though markets are really challenged right now with the COVID pandemic, and that makes markets uncomfortable. But I think the chances for venture right now are particularly attractive. And in our early stage corner of the venture market in particular, I think there's tremendous opportunity.
Yeah. So we're happy to see that entrepreneurs are as busy as ever, thinking up new ways to do things better, faster, cheaper, more dynamically so. And in that regard, I personally feel we've got to have possibly one of our most exciting deals coming out in the near term because it appeared on our radar screen, and it is just really exciting. I can't say any more. So we'll pass on that. How about the portfolio, Jim? Some of the ups and downs from the existing investments.
Yeah, certainly the dialogue with all of our founders right now is around how is COVID affecting you? How are you guys regrouping? What are the biggest challenges? What keeps them up at night? None of them are sleeping. They're really concerned, obviously. Some of them who have thought they were going to be impacted the most have turned out to find some opportunity. Intensity Therapeutics is one of those. Another company is called Padcaster. They were selling devices largely into the educational market, and we figured the educational market's going to just shut down completely, and it did. And for a month or so, it looked like, oh boy, this is really going to be a problem. But all of a sudden, they were able to tap into two new markets that wouldn't have come to them other than the COVID. And very opportunistic. They were able to open up markets. Now all of a sudden the educational market is turning back around, and their projections for next year are really bright. So I would say that we are in constant dialogue with them. Intensity Therapeutics had a case where COVID really shut down phase 2 trials. They were able to go back and parse their data in a much more granular fashion and go back to the FDA and apply for a new program to allow them to give patients full dosage of the medicine as opposed to escalating the dose over a 6 to 12 month period. And FDA thought it was presented so well that they said, yes, go ahead. So this will really, even though we lost a few months from COVID, it's going to eventually save us a lot of time in this phase 2 trial, because that can really drag on. And we should have good data back from those phase 2 trials in May, June of next year.
So another great example, talk about opportunity discovered in the middle of all this craziness. one of our portfolio companies, Concierge, which has created and developed a wearable command center using not only augmented reality and virtual reality, but artificial intelligence. So this is a device that a electrophysiologist in the first application would wear on his or her head during a surgical procedure to augment the access to data. So if they're doing an ablation procedure on a patient with AFib, they not only have the device that is controlling the catheters inside the heart, but now wearing a wearable command center, they can bring up a 3D holographic image of the patient's heart.
This is the coolest thing I've ever seen. We've actually put this on here in the office,
Yeah.
and they do a demo, and you can actually see the patient's heart beating, floating above the patient, and you can tell exactly where he's moving the catheter. I mean, it is wild. It's like Star Wars.
It is Star Wars
for the medical community. It's
so
really
here's the COVID piece. During all of this, there was awareness that a need for improved entry into vascular parts of the body, the veins that run through, in interventional procedures. And so they're finding ways to use the 3D imaging system and the wearable command center to better identify exactly where to enter into the vascular system. And of course, that is a lot of that is connected to the trauma that's going inside hospitals with the number of patients that they're having to deal with. So huge new market may be opening up. They think might even be bigger than their first application, which was in the electrophysiology space.
certainly, if anyone has questions that we haven't addressed, we more than welcome your email and would love to converse more with you. And we will get back, email one of us. Our email addresses are in the end of the presentation. Thank you very much for participating today. We hope you learned something, and we look forward to chatting with you further.